Did you know that nearly 80% of all stocks that gap up on Monday morning will see their price completely fill that gap or even reverse past it by the end of the trading day? Let that sink in for a moment. 4 out of 5 times, that exciting surge you see at the open is a mirage. And if you're one of the countless traders chasing that Monday morning gap, you are statistically set up to lose. You've seen it, haven't you? The market closes on a high note. Friday, you spend the weekend feeling optimistic, and then the bell rings on Monday and a stock you've been watching rockets up 2, 3, even 5% in the first few minutes. Your heart starts pounding. It's FOMO, fear of missing out. You think, this is it, the momentum is starting, I need to get in now before it really takes off. So you hit the buy button. And then, nothing. The stock stalls. It hovers. And then, like a slow leak, it starts to drift back down. By lunchtime, you're in the red. By the close, you're staring at a loss, wondering what happened. You fell for the Monday momentum myth. And it's one of the most expensive and common mistakes in all of trading. The belief that the initial surge at the open is a reliable indicator of a stock's direction for the day is a dangerous illusion. It's a siren song that lures in retail traders, while the smart money uses that very excitement to take their profits. Today, we're going to dismantle this myth piece by piece. We'll expose the 5 brutal reasons why chasing the Monday gap is a losing game, and more importantly, what you should be doing instead. First, let's talk about the weekend gap itself. That price jump you see isn't usually driven by a flurry of Monday morning buying. It's created by after hours and pre-market activity, often on very low volume. Think about it. The market is closed for over 60 hours from Friday afternoon to Monday morning. In that time, news breaks, earnings are reported, or global markets move. But the volume of shares traded during this period is a tiny fraction of regular market hours. This means the price can be moved significantly by just a handful of large orders. It's like a shallow pond. A small stone makes a big splash. But when the main session opens and the deep liquidity of the real market floods in, that initial price often can't hold. It was never built on a solid foundation of high-volume conviction. It was built on thin air. Second, and this is critical, you are competing against institutional algorithms. The first hour of trading, especially on a Monday, is dominated by sophisticated computer programs executing complex strategies. One of the most common of these is the gap and trap or fade strategy. These algos are programmed to identify stocks that have gapped up significantly. Their playbook is simple. They sell into that initial retail-driven excitement. They are the ones providing the liquidity for all the frantic buyers at the open. They are taking the other side of your trade. While you're buying based on emotion and momentum, they are selling based on cold, hard statistical probability, the same 80% probability we mentioned at the start. You are essentially walking into a casino and betting against the house. The odds are structurally not in your favor. Third, consider the psychology of the weekend. Traders and investors have had 2 full days to stew over their portfolios, read headlines, and build up anticipation. This creates a pent-up emotional pressure that gets released all at once at the open. This isn't rational analysis, it's a crowd mentality. And crowds are famously wrong at extremes. That initial burst is often the peak of optimism. Once that emotional energy is spent, there's no fuel left to push the price higher. The calm, calculated money waits for that emotional surge to pass before even considering a position. Fourth, you are almost always buying at the worst possible price. When you chase a gap up, you are by definition buying at the high of the day, or very close to it. There is no immediate support level beneath you. Your stop loss, if you use one, is way down at the Friday close, meaning your risk on the trade is enormous relative to the potential reward. Let's put some numbers on this. Imagine a stock closed at $100 on Friday. It gaps up and opens at $103 on Monday. You buy in, hoping it will run to $105. But if it fails and drops back to fill the gap, you're looking at a 3% loss, minimum. That's a huge, unacceptable risk for a day trade. Professional traders aren't buying the gap. They're often waiting for a pullback to value, a dip to a level where buyers have historically stepped in. They let the amateurs pay the premium price at the open. Fifth, and this ties it all together, is the phenomenon of gap filling. The market has a powerful magnetic pull towards its previous closing price, especially when there's no major, sustained catalyst for the move. That empty space on the chart between Friday's close and Monday's open acts like a vacuum. Traders see it as an inefficiency, and the market tends to abhor inefficiencies. It's so common that it's a standard technical analysis concept. The probability of a gap being filled is significantly higher than the probability of it continuing upwards. You are literally betting against one of the most reliable short-term patterns in the market. So if chasing the gap is a trap, what should you be doing? The answer is to be a hunter, not the prey. Instead of frantically buying the open, use that first hour to watch. Let the market settle. Let the algos do their thing, and let the emotional money make its moves. Your focus should be on identifying stocks that gap up, but then show strength by holding above a key level. Look for the stock that gaps up, pulls back slightly, but then finds strong support and starts making higher lows. That's a sign that real buyers are stepping in, not just the morning rush. Wait for the gap to be tested and then act. This is called waiting for confirmation. It requires patience, but it separates the professionals from the amateurs. Another powerful strategy is to do the opposite, fade the gap. This is an advanced tactic and requires strict risk management, but for those with the discipline, it involves shorting a stock that has gapped up excessively on low volume news, with a tight stop loss above the morning high, targeting a move back down to fill the gap. Remember, the goal isn't to catch the very first move. The goal is to catch the most probable move. The Monday morning gap is a spectacle, a show of initial force that often has no staying power. By understanding the mechanics behind it, the low volume, the institutional algos, the weekend psychology, and the high probability of a fill, you can remove the emotion from your trading. You can stop being the one who provides the exit liquidity for the smart money and start trading with the odds in your favor. The market will always present opportunities, but the greatest skill you can develop is the ability to sit on your hands and wait for the right one. If you're tired of losing money to these common traps and want to learn the strategies that the pros use to consistently profit, you need to be learning every single day. We break down complex market concepts into actionable, easy-to-understand lessons every week. Don't let another Monday cost you money. Hit that subscribe button and turn on notifications, because your next trading edge is just one video away.